Welcome to the Blockchain VC, a podcast about crypto and the digital assets ecosystem. My name is Tomer Federman, and I'm the managing partner at Federman Capital. We invest in the most promising blockchain startups across the globe. I have more than 15 years of experience in tech, and before starting the fund, I was on the product side at Facebook, where I led product strategy and global growth of some of Facebook's major ad products. Previously, I also lived in Silicon Valley for a few years, where I attended Stanford Business School. You can find me on Twitter at Tomer Federman. Before we begin, please note that this podcast is for informational purposes only, and all the opinions expressed on this show, either by guests or me, do not reflect the opinions of Federman Capital. Nothing on the Blockchain VC podcast represents an investment or financial advice. Please do your own research. Also, if you like this episode of the Blockchain VC and want to help us bring more awareness to the space, I'd really appreciate it if you can rate, review, and subscribe to our podcast. This only takes a few seconds and helps us get the word out. Okay, let's do this. So really excited to welcome to the show today Rune Christensen, CEO of the Maker Foundation. Rune, welcome to the show.
Thanks so much for having me today.
So I guess to get started, Rune, would love to learn more about your background and how you got into crypto.
So I actually got into Bitcoin in 2011 because I saw a Bitcoin address on some random website. And then once I saw that Bitcoin address, I was like, I had to figure out what that is. And then I basically jumped into the Bitcoin rabbit hole and became really, really interested in Bitcoin for several years and put all my money into Bitcoin as well at $80. But then what actually happened was that I ended up, so the Bitcoin price went up a lot, but then it also crashed and I actually lost almost all of my gains. And from that experience of like losing so much money, I realized that what's really needed to make the Bitcoin story and the blockchain story in general really appealing is that this issue with volatility needed to be solved. So from there, I got into stablecoins. Initially, the BitShares project, which was the first ever stablecoin. And then eventually, me and other people from the BitShares project essentially like moved onto Ethereum and took the best aspects of the BitShares stablecoin model and implemented that on Ethereum. And that's what then became Maker as it exists today.
So when was that?
So that was actually, I started working on an Ethereum-based stablecoin very, very late 2014. So actually even, before Ethereum had even launched. Yeah. That was, we were one of the absolutely first Ethereum projects. And we were like on the original Ethereum website as one of the projects. And I think one of the only ones that have stuck around until this day alongside like Augur and Digix and just a few others.
Got it. Sounds like you weren't a fan of the volatility that comes along with investing in Bitcoin, and I guess most crypto assets in general. Is that because you were more interested in the application of crypto assets as a medium of exchange, or what's kind of behind it, right? Because obviously Bitcoin advocates are in it because they see it as a store of value, right? And as basically the equivalent of digital gold. Sounds like that's not really what you were most interested in.
Right. I certainly do think that Bitcoin and any other crypto like Ethereum as well has the potential as digital gold, right? And that in some cases can be great for speculation.
Right.
But in the early days of Bitcoin, when I joined, right, like the vision was completely different, right? It was actually about doing a lot of the things that DeFi and stablecoins are now finally getting done today. So I guess you can say that it, for a lot of people, and I guess this is also what drove a lot of people to, for instance, Ethereum, was that the vision kind of changed due to the technical constraints and then just the fact that the volatility wasn't going away. So, it's just like different, there's different types of technology has different use cases, right? And Bitcoin's use case turns out to be digital gold, which is great, but it's not the original vision of digital cash, right? And that's where what me and a lot of other people realized is that to get from digital gold to digital cash, what you need is the stability.
Yeah, absolutely. If you don't have stability, I don't know how you can use it as digital cash. Okay, so what is, for I guess the very few listeners who may not be familiar with Maker, what is Maker?
Maker at its core is the decentralized autonomous protocol that maintains the stability of the DAI stablecoin in a fully decentralized manner, so that one DAI can actually be equal to $1 in most cases, without needing a central counterparty or some sort of authority that controls and regulates and sort of promises to keep the value of DAI. Instead, it's maintained through this protocol, which on one hand, what the protocol allows for is the creation of DAI, and on the other hand, it's also the creation of decentralized credit. And through that, it's essentially like a two-sided marketplace that the Maker protocol facilitates, where you have the stablecoin users who are, they're looking to use DAI as money and for stability. And then on the other hand, on the other side of the coin, you could say, you have what we call vault users. And so vault users are very advanced kind of user that actually deposit collateral, so other Ethereum assets into the system. And through these Ethereum assets, accesses collateralized lending. That's also fully decentralized and autonomous. And in fact, it's kind of like, it's like giving yourself a loan, essentially, the way that the protocol works. And it is through that process that the DAI is then created. And ultimately, it is also through this, the collateral that exists in the system, that DAI is backed and has this provable stability that you can trust. But the critical thing is still that this is all a decentralized protocol, and this is all peer-to-peer by a completely free market of participants. So again, it's actually possible for it to happen without a central counterparty or authority.
So one of the interesting aspects about Maker is that it's decentralized, which is the point you just made. And I think you're taking a different approach than some of the other stable coins that we see out there. In particular, I'm curious, Rune, there's this thesis among some participants in the market that claims that for a stable coin to be successful, it needs to be regulated and controlled by the government. DAI is very different than that. How do you respond to people who claim that DAI and any other stablecoin needs to be regulated by the government in order to be successful in the long run?
Our thesis is that it's not just the government that needs to regulate a stablecoin for it to be safe and not crash. It really is everyone, right? Because why is it only the government that should have the insight and also the ability to actually try to change things in a more positive direction? Because the government isn't always right? For instance, the financial crisis happened and the CDOs crashed, and all of that happened despite the government supposedly regulating that, right? And the direction that Maker is taking is by decentralizing everything on a completely unbiased protocol where everyone has equal access and everyone has equal insight, and everything is completely transparent. It means that every single user has the ability to, for instance, audit the system in real time. And everyone also has the ability to suggest changes and even vote in the system and participate in the governance. And that also means that central banks and governments can participate, right? But it does also, of course, mean that there's that there's limits to how any individual can impact the system, right? Because you never want a system where there's a single authority that can just rapidly change things, right? Because that could also be used for bad potentially, right? So that's what we see as a big advantage of Maker.
Yeah, but I guess what I'm wondering is, if we go beyond the individuals and the long tail of users, do you see major banks, major funds, and so forth investing in and using a currency that isn't regulated by the government? I mean, I think they also have some limitations in place, right? Just in terms of their own internal mandate and what they can and cannot do.
Right. So ultimately, DAI and the Maker protocol are just tools. And if you have something like a bank that starts to use it in some specific way, then that doesn't exempt that bank from banking regulation, right? So it still means that if you're using DAI in certain ways where you're clearly doing regulated activity, then you're subject to that type of oversight, just like everyone else. And of course, it is going to be a very big challenge and a very a long road to properly navigate how do you actually integrate blockchain technology and decentralized stablecoins into the legacy financial system, right? But I think that already today that is certainly possible in some of the more innovation-friendly jurisdictions around the world, and I'm sure that it's all a question of doing things step by step, right? So as sort of the more aggressive financial institutions and the challenger banks and the more innovative, jurisdictions and governments, as they start to experiment with the technology and they actually start to reap the benefits and generally just figure out what is the value of this technology to society. And as that becomes apparent, then it'll just be like dominoes, right? You will just see bigger and bigger countries and jurisdictions embracing blockchain instead of rejecting it because of the bottom line, right? Just the fundamental advantages that they get, which is, efficiency, lower fees, right? And then also the transparency and the decentralization provides a level of risk mitigation, as well as, it kind of it makes it easier to trust the system, while at the same time means you don't really have to trust it at all, right? You don't have to trust anyone because there's no central counterparty that could take all your money away, right? So these are all benefits that actually, especially governments and regulators love, right? Transparency, that's great. That's, one of the biggest problems with the current system is exactly the opaqueness, right? And that's what caused the financial crisis, for instance, right? So the fact that there's a technology that actually provides these concrete benefits that regulators and governments are looking for, I think makes it very clear that as long as things are done step by step and, the technology is adopted carefully and conservatively and with a very much, like a risk-based approach, right? To ensure that nothing goes wrong in the early and experimental phase, then I could absolutely see it become potentially the cornerstone of the global financial system as we know it.
Yeah, that's super exciting. And I guess I've heard you referring to why you've decided to peg DAI to the US dollar. Previously, you talked about the dollar being obviously the dominant currency right now, the global reserve currency of the world. My question is, do you see a world where at some point in the future, DAI wouldn't necessarily be pegged to the dollar and potentially you'll make it even more independent and decentralized and look into a currency where you control the monetary policy? I mean the Maker Foundation.
Well, yeah, so just to clarify the Maker Foundation. So the Maker Foundation is actually going to dissolve and it's not going to participate at all in the governance of the system. But so just to make that clear, right? Because if the Maker Foundation had that kind of role in the system, that would completely negate all the decentralization benefits, right? But the system is governed by the MKR holders, right? So the people who hold the MKR token and who use that to vote on the blockchain. And then there's also on top of that, like a lot of processes of checks and balances that ensures that basically through game theory and through aligned incentives that MKR holders then ultimately benefit by voting according to what the users prefer and what what's best for the broader ecosystem and overall stability. And in that context, it absolutely makes sense that it might not always be the best for the broader ecosystem and for the users to keep DAI pegged just to the US dollar forever, right? Because there could be all sorts of reasons. Maybe the US dollar just stops being so dominant on a global scale, or maybe there's even US dollar hyperinflation. It could be any reason, really, right? So there's no reason why the governance of the system should be constrained by that. And that's actually why it's called DAI and not called something like MakerDAO or similar. So the idea is that one day DAI could transition away from being pegged to any single currency and could instead target something like either a currency basket or even a CPI basket, and try to be essentially like a global currency, right? That isn't meant to serve any particular economy at any specific place, but instead just serve the international community and the global economy. But at the same time, of course, it's very important that people can, use, if they want to use blockchain technology or they want to use DeFi, it needs to be possible for them to use that in a way that's familiar, right? You don't want to start using some new technology and then you have to learn all sorts of things and use weird currencies that you don't understand, right? So that's like a really important point of having US dollar, because a lot of people recognize the US dollar. But actually, it's not enough. We need to go beyond that, because it's, for a lot of people, actually the US dollar is just another weird foreign currency, right? Like in Europe, people don't want to use US dollars. They want to use euro, right? And in Japan, people want to use yen and so on, right? Like there's so many countries where people, in fact, most countries, obviously, people are most comfortable using their local currency. So the Maker protocol and Maker governance is actually able to, over time, expand the range of stablecoins that the protocol makes available. So today we only have DAI, which is pegged to the US dollar. But in the future, we could have the Euro DAI, which would be pegged to the Euro, and Yen DAI pegged to the Yen. And maybe we would have the US dollar DAI that would be pegged to the US dollar, and then DAI itself would then be pegged to a global basket.
Mm-hmm. Right. Makes sense. So I think that's a good segue to a discussion about what you guys just recently launched on November 18, the multi-collateral DAI, which I think is super exciting, and would love to hear more about that. So maybe before diving deeper, do you want to tell people a bit about the change you've made and the move from single collateral DAI to a multi-collateral DAI, which is now backed also by a basic attention token?
Yeah. And so what we've actually done is just about 9 days ago, we actually launched what is essentially the full realization of the original vision of the system. So, I mean, DAI has been live for more than 2 years now, but that's been the versions of DAI that's been live in the past have always been essentially kind of like early versions of the system created just so we could try to experiment with it, right? And so we could start growing the ecosystem and allow things like the DeFi movement to emerge. But ultimately, the singular goal has always been to create a stablecoin that really is future-proof and that really can scale and that can offer all the options and all the possibilities for the governance to do whatever they want in order to control the system in a fully decentralized manner far into the future. And that is what we have now launched. So, and then one of the key features of the system is the fact that it supports multiple collateral types. But there's actually also a lot of other new features to it, including better security and better game theoretical defenses that protects against all sorts of cryptoeconomic problems that can exist in decentralized stablecoin systems, and also better governance tools and sort of more freedom for governance, including the ability to also create more stablecoins than just DAI. So it's incredibly exciting that we've launched this, right? Because this is really the culmination of almost 5 years of work that's finally now been released, and it's a huge step towards what I was talking about, which is the dissolution of the foundation, right? Towards the point where even the Maker Foundation is not even needed anymore and can simply go away, and allow the Maker governance and the ecosystem to just fully run all aspects of the system, right? And even things like the further development of it.
Yeah, absolutely. And the way I think about it, and tell me if you agree, the single collateral DAI, you had a fully functional credit generation functionality there. But with the multi-collateral DAI now, the opportunity to diversify collateralization there, I mean, the use cases that opens are just mind-blowing, right? And potentially extending beyond just crypto, right? Like potentially you can have real world assets added there as collateral moving forward, which would be revolutionary.
Yeah, and that's the whole point for what we've been doing, right? It's always been about a stable coin is so we can create this stability and this familiarity that will allow regular people to actually enjoy the benefits of blockchain. But that also means if you want to, like, that's the stablecoin part, right? If you also want to make the credit system and the decentralized credit platform relevant for regular people and for the real world, you of course also need to be able to accept collateral that is more than just crypto. Because that's how you actually have, that's how we're going to get this real world impact. And there are so many incredibly cool examples of this, right? And one kind of like very classic example, because it's quite easy to understand, would be imagine that you could use your house as collateral. So you could turn your house into a token, and then you could put that token into the Maker protocol, and then you could actually generate DAI based on that token of your house. And this way you've created a fully decentralized mortgage, where you don't need to use a bank as an intermediary. You don't need to give away your data to so many different counterparties, and also you will just get really, really good rates because you're interacting directly with what's similar to a money market instead of going through a lot of intermediaries. Yeah, and it just extends beyond that, right? There is things like trade finance, lending to small businesses, micro lending, using commodities and bonds and so on as collateral, right? And it also just means that as a DAI holder, you become a lot safer because now you don't rely on just a single type of value to back your stability, right? So even if the Ethereum price totally crashes to almost zero, if the collateral is highly diversified, it actually doesn't matter at all. The system will just totally absorb the loss and keep going.
Right, which brings up a really good point because crypto assets, by their nature, at least in terms of where we are right now, are very much correlated one with the other. But once you bring on board real world assets and you diversify, then the risk potentially could go down exponentially.
Yeah, absolutely. And the thing is also just, and this is kind of what in a way, the secret to the whole project is, right? That the fundamental essence of how you make this successfully is you need to be really good at managing the risk of all of this, right? Because crypto is all correlated and is also highly volatile. But then if you go and look at something like real world assets, then you suddenly have to deal with regulation, right? You suddenly have to deal with the fact that now there actually are, in many cases, central counterparties and custodians, and changes in the geopolitical climate and all these different factors. And what the MKR holders have to do is they have to balance out all of these risks against each other, right? So they have to make sure that there's not too much correlated crypto that could all crash at the same time, but also that there's not too many assets held in one jurisdiction or too many assets of the same type that could also all crash or something. And through this, it should ultimately be possible to create just a highly resilient portfolio of assets where even if there's a huge crash, it's fine because that's hedged. That risk is hedged by you having a lot of, for instance, centralized custodial bonds or something like that, right? But then those bonds, they maybe have a risk of getting frozen or seized by the governments. So you hedge those by making sure that you actually spread out those assets across many different jurisdictions, right? So it doesn't matter if there's one jurisdiction or even 3 jurisdictions that try to do a crackdown because you're spread across 100 jurisdictions, right? And there's so many different aspects like this that ultimately the complexity is, is very high, right? And it's going to take a lot of research and a lot of time to really get to a point where you can scale this kind of massive portfolio. But that's what we've been working on that for 5 years already, right? And we already have like an incredibly, just like a very knowledgeable community that actually, are beginning to sort of understand all of these factors and all of these risks, and trying to like map out the path forward so that we can safely scale.
Yeah, so there's two elements to it, right? By introducing multi-collateral, the concept of multi-collateral assets, you basically improve the stability of the system and you diversify. And then on top of that, the second element is basically all the new use cases that this introduces. So potentially we could see completely new ways of structuring capital and potentially moving away from the traditional debt and equity financings that we know today. To your point about the example of tokenizing your house. So it seems like there's two different, very distinct but important advantages to introducing MCD.
Yeah, exactly. And there's some really fun examples as well of like completely new use cases.
Yeah, what's the use cases that you're most excited about?
Well, I mean, I just think an example I really like to bring up because I think it's very unique, and also it's actually something that we would expect to come quite soon. And that is, so like the first example of this kind of use case is what we're doing with a startup called Paperchain. And so Paperchain is a startup that tokenizes Spotify royalties. So it allows, I would say like medium success artists, right? So like artists that aren't necessarily in the big music industrial complex, right? But that still have actually successful music on Spotify and that are earning royalties from that. So right now, they still don't have, just because you've got royalties on Spotify, it doesn't really give you that much value in the short run, and doesn't really help you so much to kind of like compound on top of your success, because those royalties are going to come in over the next many years, right? And so by tokenizing royalties, it allows an artist to then, access finance in various ways. So one thing could be just selling the rights to the royalties entirely, but with Maker, a new option becomes available, which is simply collateralizing those royalties and essentially using the Maker protocol to give yourself a loan that could then finance, for instance, your new album or something like that. And I just think that's like a really exciting and really cool example, because this is how the blockchain and how DeFi starts impacting the real world, right? Maybe there's actually in the future going to be music and like great, artistic works that only exist because the blockchain allowed it to happen. And I think that's the kind of, that's what it's all about, right? It's not just about, speculation and pumping and dumping and all that kind of stuff that people have typically associated with blockchain and crypto, right? It's actually about using technology to improve the world.
Yeah, absolutely. And the music use case is one that I hear a lot about, and I think it just makes a lot of sense for blockchain in general to help address rights management. So one change you've also made as part of the MCD is in the old system, right, with single collateral DAI, the stability fee was paid by Maker. And now with the MCD system, basically the owners of CDP, or what's now called vaults, are paying that fee in DAI. Why did you make that change?
So the thing is that in practice, actually, even in single collateral DAI, most users ended up paying like as they kind of like using the the front ends and like using things like the CDP portal that was created by the foundation. They were given the option to still pay in DAI, and that's for convenience, right? Because if you're someone who's you just want to generate some DAI and kind of like access some liquidity in your ETH without having to sell it, and you don't really care about MKR, like then it's actually really annoying to have to go out and buy another token, right? It's just inefficient and a waste of time, right? So it was built into the various front ends that as you go to pay down your debt and retrieve your collateral, the front end of the wallet just automatically takes it tells you to pay a little bit more DAI, and then it takes that extra DAI and just buys the MKR for you and takes care of paying down the stability fees. So in multi-collateral DAI, that's just built in even more efficiently on the back end of the system, so that the protocol itself handles this essentially in the same way that the front ends and the wallets have been doing it, right? So you just pay DAI to the protocol, and then the protocol takes care of actually buying the MKR and using it as like burning it as gas.
Mm-hmm. Yeah. So it's mostly about convenience and kind of reducing the friction, basically.
Yeah, exactly.
Got it. And why BAT? Why basic attention token as the first collateral? And also, how much input do you have into that? Because I know obviously maker holders, as you described earlier, voted on making that change and voted in favor of adding basic attention token. How much input or how much guidance do you provide there as the project leader?
Well, so specifically when it comes to these BAT getting added as a collateral type for launch, I obviously have absolutely no input in that at all, right? Because the foundation takes care of things like developing the protocol, right, and also doing outreach and education and marketing in some places, right? But the governance of the protocol itself, so like once we've built it, once we've done the outreach, then it is entirely up to the MKR holders to actually control the protocol. And that's not just that's not just something we say, that's actually how the technology works. So that is the only way it can be done. There's no other way to do it. It's only through MKR votes that anything can be done in the protocol. So, as when multi-collateral DAI was launched, that was done with like the power of the what's called the executive vote. So like a vote that actually changes the state of the system, and that's initialized by having enough MKR holders supporting it. It is right now the foundation through what's called the interim risk team. So essentially, like the community in the past has approved the foundation to act as this kind of like this role in the community where the foundation creates the proposals that are then voted on. Like, so even though anyone can actually create proposals at any time, it obviously takes some effort, especially to do it securely. So it's important that the community designates someone who actually have that responsibility to do it. And so right now the foundation is doing that. But when the foundation, it doesn't mean that the foundation just decides whatever they want to put up for a vote. Instead, when that decision-making process is also done by the voters. And so specifically for the BAT token, I believe it was about two months before the launch, or possibly even 3 months before the launch, the community ran what we called a priority poll, where basically it allowed MKR holders to rank their preferences for different types of assets that they wanted to use as collateral. And so there were 7 collateral types available at that point in time that people could choose. And those 7 collateral types were actually, and the reason why there only was 7 was because they were the ones that had been already tested and implemented securely from a technical perspective.
Is that the main criteria in your mind? Like how much they've been tested and been proven to be secure?
Well, I mean, that is the base level requirement for it to be possible to even add it to the system. Like, so there needs to be some engineering done to kind of like fit it together. And that's through something called an adapter. So the adapter is kind of like the smart contract that allows a particular token to be used as collateral in Maker. And so 7 tokens had been used in testing by the engineering team in the foundation, actually for about a year at that point. And so they have all been tested in the system on testnets. And that's why they were the ones who were available for the community to pick as something that would be in the launch itself. But of course, going forward, it's going to work the other way around, right? The community tells the engineering teams what they want to add as collateral, and then the engineering teams will do the testing on those particular assets, right? But basically, because we didn't want to delay the launch for the sake of adding more collateral, only those that had already been tested were available to choose before the launch. But then everything else will be added after the launch, right? So once the whole protocol and sort of the upgrade process has stabilized more, then I would expect that the governance will start to resume sort of, or kind of like will begin its new mode of operation that also, that includes regularly onboarding new collateral. And then that'll be in a process that's completely new, right? That'll be made up by the community based on just like observing what works and what doesn't work and trying different things, and ultimately trying to consolidate on like a process that is both efficient but also secure, and through that just onboarding as many assets as possible.
So I know you mentioned that you expect in the coming weeks and probably months to have a lot of weekly debates and calls among the community to make these types of decisions. Do you have a sense of the timeline in terms, like, let's say, fast forward a year from now, how many tokens can we expect to have as collateral as part of MCD? Do you have a sense of that?
So in the short run, what has right now been agreed by the community is that up until next year, we are going to, like, the governance will basically run in this in what's called kind of like a migration phase, essentially, like a migration cycle. So kind of like a period of time where the focus is not really on operating the system the way it normally should operate, but rather the focus is on protecting the systems from the specific risks that exist in how the upgrade process from single collateral DAI to multi-collateral DAI will run. So I don't expect that much will happen this year, but then once the upgrade process has moved forward and the community feels more safe about the whole thing, then I would expect things to start picking up the beginning of next year. And as for what's going to be, like, how many collateral types that will exist next year, I mean, at the end of next year, it's impossible for me to predict. But I think, I would expect a lot. Like, I would expect it to grow exponentially. So it's going to be about, like, initially it'll be very carefully onboarding of just a few assets, but then as MKR holders and the ecosystem starts to feel more familiar about the process and feel confident that this actually works, then we'll start to try to test the limits of just how much the system can scale, because it really is designed to, like, it's designed for scale, right? So I would expect it to definitely scale.
And do you have like a number in mind? I guess I'm wondering, is there a limit to how many tokens you can add or want to add? Maybe there's a point where it's too much and actually doesn't add a lot of benefit, or like, how are you thinking about that?
Well, so there's certainly no limit. I mean, it really is about growing it to as big a size as possible. But the essential problem is risk management, right? So what is so important is that as the system grows, it needs to grow in a way that's healthy, so that the collateral is diversified as more and more assets are onboarded, right? So what it means is that if there's an explosive growth and a lot of crypto is added, right, that means that also that has to be balanced out against some real world assets to hedge the risk of the specific risks that exist with crypto and its volatility. And if, let's say, a lot of something like real estate tokens are added or something, then there also has to be a big amount, a lot of diversity and a lot of assets that are just not correlated with real estate. So maybe commodities and, stocks or something like that could be different. And of course also crypto itself, right? And gold and all of that stuff, right? So that is basically the only thing that matters, is that as the system grows, it needs to grow in a very holistic way where every aspect of the collateral portfolio manages to grow and manages to diversify. And as long as that's the case, there's really no limit. I mean, then the system really should be able to just grow to the point where it almost absorbs the global financial system.
Yeah, that's fascinating. I mean, we're in uncharted territory. I don't know that any company or startup tried to do that before, which is, I guess, part of the reason why I find it just so fascinating and exciting. And what's your sense of when you will add assets from the more traditional finance world as opposed to crypto assets?
So there's already a number of projects specializing in tokenizing assets so that they can be used as collateral in multi-collateral debt. And there's actually also been a few proposals by projects who came to the community and are basically suggesting that their assets should be added soon as collateral and to test out what it's like to have real world collateral in a portfolio. But I mean, what's happening, of course, is that because this is going to be the very first time ever that real world assets will be onboarded by the governance community, and also because the governance community only now is even beginning to consider, to like fully consider the process of what it actually takes to onboard any asset, whether it's real world collateral or not. So a lot of this is about ice breaking, right? Which means it takes quite a while to kind of like get all the things in place and figuring out how to deal with things like regulatory risk and so on. So I mean, I certainly expect several months, right? But I would not be surprised if we have some real world assets in the collateral portfolio in like the first half of next year.
Yeah, and I saw also the collateral onboarding guide that you published, I think it was in July, right, about how to nominate tokens for multi-collateral. It's going to be really interesting to see how that evolves. One other thing I want to touch on as part of this recent launch, you also introduced the concept of the DAI savings rate, right, DSR, which basically makes it possible to earn savings by simply holding DAI, then activating a smart contract related to that. The rate you set is about 2% right now. And I find that super compelling and interesting because, yes, you have the risk of decentralized finance in general and using smart contracts, but there's no counterparty risk here. You remove the middleman and you can start earning interest and liquidate that or withdraw your digital cash at any point in time.
Yeah, I mean, the DAI savings rate is essential to what makes the Maker protocol so powerful, because it is through the DAI savings rate that the protocol realizes so much efficiency that ends up benefiting the end user by essentially charging the cost of capital in the form of a stability fee to the vault users that deposit collateral into the system. But then as that value flows into the system, most of that value is then also paid out to those who provide that capital into the system by holding DAI. And right now in the financial industry and in banks, the spread that a bank will take between what it pays out to those who deposit into the bank and then what it demands from those who borrow from the bank, that spread is at, in sort of the most hyper efficient cases, that spread would be 3%. And it is like, in fact, that's actually never possible for a regular person, for like a retail customer to get that lower spread. But even, so a retail customer will pay a spread of 4%, or 5% maybe. And most likely a lot more even. And with the Maker protocol, we are starting out, like in the very beginning, the spread is 2%. So it's already below what what is even possible to get for the most privileged customers of a bank. But likely that spread will go even lower. There's not really anything like it is up to Maker governance to basically carefully decide how to manage that spread over time. And the general consensus is that the spread needs to be as low as possible, right, for maximal efficiency, so to benefit the users of the system as much as possible. And of course, the critical thing is that the spread also is a part of risk management. So it's not like, the protocol can just pass on all the stability fees that are paid into the system, just pay all of that out as DAI savings rate. That would be risky. Like that actually wouldn't be sustainable. But it can be very close to the risk premium, right? So like the average rate of default over time in the system, and that's just such a if we can actually get that, get a financial protocol that has a new, just way better efficiency than the current banking system, and we can get that in as kind of like the backbone of the financial system, then what that means is that these efficiency gains will be realized everywhere, right? So essentially it will just make all of society richer and everyone better off, because the banks will be taking less, right? Like it won't be like today where the financial system is almost like taxing everyone just by running their services so inefficiently. It'll be the opposite. It'll be the financial system is completely transparent and is hyper efficient, and the value created from that efficiency is passed on to the regular people, thus benefiting everyone.
Yeah, absolutely. And I would say also like the simplicity of it, right? The few clicks, you can start earning interest on your cash, your digital cash. I remember I saw somewhere, I think it's your head of smart contracts, right, Mariano Conti, describing how he uses DAI for savings in Argentina in order to protect him and his family from the devaluation in the Argentine peso. And I just thought that's just so compelling. And you can see how many people in Western societies, but also in emerging economies, people who are unbanked or underbanked, this could have huge impact on their daily lives.
Yeah, absolutely. I mean, and so Argentina is definitely the place where DAI has the most traction right now. There's really this organic demand, an organic ecosystem of regular people using DAI to escape the hyperinflation of Argentina right now. And also DAI in general is the most popular stablecoin in South America. So that's we're really proud of that we've actually managed to get that kind of traction in the real world with real people who use it exactly just to mainly to escape the inflation of their national currencies. And so adding the DAI savings rate to that is of course an even bigger deal. It's DAI in its current state is already very interesting for a regular Argentinian to use in order to avoid hyperinflation. But then being able to get that savings rate, getting that extra low risk yield on your money, that's just that just really makes for a very high potential product, right? That we believe can really be adopted very broadly in South America.
Absolutely. And when you think about the use cases beyond that, because you can use the savings rate, you can implement it on the back end of any DeFi product that uses DAI. What are some of the use cases that maybe you already see there being developed or that you're most excited about?
Yeah, so the really compelling thing about the DAI savings rate is that it's inherent to the protocol. So that means you're not taking any extra risk when you're getting the DAI savings rate, which is, different from if you go to a DeFi lending platform or something like that and lend out your DAI there. When you're doing that, you're actually you're giving away your DAI to someone else, and hopefully they'll pay it back to you later plus interest. But the DAI savings rate is not lending out your DAI. The DAI savings rate is simply the Maker protocol having built into it's built into the Maker protocol that it will send you these DAI savings rate payments essentially in real time.
Right. That's the amazing thing about it, right? It's basically you and the distributed ledger. There's nothing in between.
Yeah, exactly. And that means that you're not taking any extra risk. And for that reason, you should always be getting the DAI savings rate at all times. So for that reason, we expect that pretty much all wallets and all like DeFi platforms and services, they will implement the DAI savings rate so that you can automatically get the rate, right? Get this extra return anytime you're holding DAI or using DAI on any kind of platform. And even centralized exchanges will likely do this because it's just, again, it's risk-free additional savings that you can earn, right? So there's no reason not to do it. So that's already really cool when we look at that in the context of using different DeFi platforms or wallets and just make it really convenient to earn a return, right? But also
Risk-free, you mean other than the risk of using a smart contract and the inherent risks there?
Yeah, absolutely. I mean, no additional risk if you're already using DAI. So of course there's risk with using DAI, right? But there's no difference in risk between using DAI or using DAI that's getting the DAI savings rate. The risk of those two things is identical. So that also means that if you are like a small business, for instance, or even any kind of business or enterprise, and you are running some of your accounting in DAI, then suddenly you can start earning a return on your float. And that's a huge deal because there's so much money lost and there's such a high cost right now to this, the dead capital that exists in small businesses. And when you're doing these like, enterprise transactions where you're sending, let's say, a $10 million payment, and maybe it takes 7 days for it to sort of fully pass through the accounting system and be fully processed because it's a very large payment. And in the traditional financial system, very often during those 7 days, that a lot of interest is actually earned on that money, but that interest doesn't go to the business. That interest goes to the bank, who just take it because that's how it works. And with the DAI savings rate and the transparency and efficiency of the blockchain, now as a user, you get that money and no one else takes a cut of it. And that's just a huge deal, right? It's kind of like how we can go out there and we can make so many small optimizations all over the place in how enterprise currently works.
Yeah, absolutely. One thing I also wanted to ask you with regards to that is, how did you get to the 2% savings rate that you have right now? Like, why 2%? Why not 1% or 3%? Like, what's the logic there?
So the thing is that the starting value, first of all, the starting value doesn't actually mean that much because it's just the point where it begins and then governance takes over and starts actually modifying it. So the 2% number, like in general, you can only kind of like reason about it in relative terms. So you can say, should it go up or should it go down? You can't really say you can't sort of in advance say it should be some exact number and then just know in advance that that's going to be the right number. So 2% was picked mainly as kind of like, first of all, based on it just needed to be something positive. So it didn't start off as 0, since that might just make it harder for people to understand what's even the point of it. And then, I mean, some people believe that 2% is where you would expect like a fiat-pegged stable coins, sort of like base return to equilibrate towards in the long run, because central banks target a 2% inflation. But it's actually not. I mean, generally the whole science and even philosophy around how things like rates of return and interest rates they work, it's very difficult to really say anything exact about it. So ultimately, the 2% number is just a starting point, and it's very quickly going to change. Like I said, there's already ongoing discussions in the community about reducing the spread that the protocol charges. So what that would do is in the immediate term, that would increase the DAI savings rate. However, it could also easily go down or even go up even more depending on the market dynamics of supply and demand of DAI, right? So basically, yeah, it's going to be where it needs to be so that DAI remains stable and so that both DAI holders and Vault users have access to their services at very high liquidity.
Makes sense. How do you drive growth? Obviously, DAI has gone incredibly fast, certainly over the past few months. You've recently announced that you've passed 100 million DAI in circulation, which is a major milestone. And we've also seen, I think, like just over the last 3 months, like 81% growth in DAI locked in DeFi. How do you drive such growth in terms of adoption? Do you spend a lot of money on marketing, or is it purely organic?
So the growth that has happened in single collateral DAI up until this point has been entirely organic. So that growth has come purely from the foundation releasing the system and then the Ethereum community just adopting that system and just growing entirely by itself. So
really, so you have no marketing budget?
Well, so I mean, so the foundation has a marketing team and it has a marketing budget and has been doing like small experiments with it. But basically, because single collateral DAI was not the full version of the system, there was never really done any real kind of like marketing campaigns. And rather, the focus of the foundation was always to appeal to the builders and the core ecosystem and the startups to build with DAI and build on top of it, rather than trying to push it to the end user, because it just, that was just the right thing to do at the time. And that's still that will always be the main focus of the foundation, right? Up until the moment the foundation is dissolved, the primary purpose of the foundation is to create a very, very robust and self-sufficient ecosystem around the protocol. But additionally, we are also going to begin actually doing larger scale marketing campaigns than what we've done so far. So basically what we've done up until this point is just like very small scale experimental marketing, mostly for market research and gathering data. And then now that MCD has launched and essential features like the DAI savings rate and also the ability to scale through multiple collateral types, with that in place, it's actually possible to go out and do things like even ads and that kind of marketing. And the place we are especially going to target is, of course, South America, right? Where we already know there is this organic demand, right? And organic growth. And where there's already a lot of attention to the project. So we're partnering with a lot of the blockchain infrastructure there. And then we are looking to how we can do things like advertisements around the benefits of DAI to regular people in those countries. And but also just like a lot of like what we also just do is like things like localization and translation and just like localized educational material and that kind of stuff. So we ultimately, again, facilitate the community to provide the real organic growth.
Mm-hmm. And as the team grows, so correct me if I'm wrong, the team is working remotely, right? Like you guys are a pretty distributed team.
Yeah. So the Maker Foundation has a very big team, right? So there is 93, I believe, full-time employees of the foundation. And so I would guess around 30 to 40 of those people, they work in our offices. And so we've got some small offices around the world. So we've got an office in Buenos Aires, San Francisco, New York, and then Warsaw and Copenhagen.
Got it. So it's not people working remotely. They actually do go to a local office.
Yeah.
And work with each other.
Yeah, some people do that, but the majority still does work remotely. So all in all, we have people from 22 different countries working on the project.
How do you see that scaling as the team grows, as you're driving more and more adoption? Are there any challenges there? Let me caveat that, right? I have a bit of a bias on that because, at least in my experience building products, I've always noticed that when the team is actually centrally located, whether it's in one office or in multiple offices, You have the team members working one next to each other. It's just these casual conversations tend to foster a lot of innovation. And so many times the best ideas that we have came from, just hallway conversations or, over lunch and so forth, nothing really that was planned. How do you manage the team remotely? How do you manage to do that effectively?
Well, I think the number one important thing to always make sure happens is to have a lot of meetups, right? So people actually meet in person. And then on top of that, we also have, like it's kind of like everybody works in the same office, and that office is like our chat room, right? So we have all these internal, we have this internal chat, right, where that's where all the discussion actually happens, and that's kind of like where the organization as a whole communicates. But ultimately, I think remote work, and especially even though we aren't like not everybody in the organization work remotely, we still are essentially a remote only organization. And that's because our teams are all structured so that people in one office never work on the same team. So they're always like a part of a remote team, and the other people in the same office are not going to be part of the same team. And that's critical, because if you don't structure it that way, what happens is you always get sort of two teams. You get the team that's co-located, and then you get sort of the other team that's the remote team, right? So, and we do actually also in fact have a single team in the organization that is entirely co-located, and that's the Oasis team, which is based out of Warsaw. So they are all focused on a single product, and so they work kind of in a different way from many of the other teams in the foundation. And I think that's really interesting, right? And there's pros and cons to each approach. And I think by far the greatest advantage of remote work is you just get access to a completely different level of talent, right? And that is ultimately the strength that we have in the Maker Foundation, is that we've just got most of the just supremely talented people in the blockchain space, right? Like the people are kind of like wrote the book on smart contracts. Like most of those people, they've been working on Maker, right? And that's what's enabled us to create such an advanced smart contract system securely.
Yeah, you mean just because you're not limited to any specific geography in hiring the best people?
Yeah, exactly. And also because when you're looking at something like really, really talented developers, or just like really specialized researchers in specific areas of blockchain development, they just never, like, they don't have to be located in a specific place, so they don't want to, right? They want to be able to work however they want, right? And all they need is a computer to do their work. And that's very often how, that's how everyone in the early days of Ethereum saw the whole prospect of working on blockchain, right? And then, of course, like now that the world has changed a lot, right? And blockchain is a completely different space. Now there's also a lot of people do absolutely prefer to have the office space. And also, again, it's all about making sure that there are those meetups, right? And that people meet in person as often as possible.
Got it. So basically, employees have the ability to decide whether they want to come into the local office or just work completely remotely.
Yeah.
So last question, Rune. How closely do you follow the Ethereum 2.0 progress, and what are your thoughts about their planned move to proof of stake?
I don't really follow it too closely, but I have been following it for the past 5 years, right? As long as I've been involved in Ethereum. And it's changed a lot over the course of all these years, though in a way it also hasn't really changed. In the end, it is quite similar to what was originally envisioned, in my opinion. But actually, in the Maker Foundation, we don't really view Ethereum 2.0 in the same way that a lot of other people do, because the way that we think about scalability in general, and just like the question of like which blockchain to choose in general, is that you don't have to ever depend on any single blockchain for your scalability, or just in general. it's actually possible to engineer blockchain applications that are what we call, internally we call it blockchain transcendent. So basically, applications that aren't anchored to a single blockchain, but instead you could have something like the Maker protocol simultaneously exist as a single system, but that spans across all the different popular blockchains. And that way you get to get the massive performance benefits of having, many parallel blockchains and just like having a lot of capacity and a lot of nodes. And you even get to have sort of the choice and sort of the freedom of many different options when it comes to what kind of trade-offs you want to do, right? Do you want to be on a more centralized blockchain with extreme performance like EOS, or do you want to go on Ethereum and just like maximize decentralization, or do you want something in between, right? Or do you want a permission blockchain? Like decentralized protocols can actually, like through cross-chain technology, they can actually bridge all of these gaps. And so what that means is that Ethereum 2.0 isn't like, for us, that's not when Maker can finally scale. Because already today, there's bridges between Ethereum and EOS, and there's actually DAI transactions happening on the EOS for some specific, mostly gaming-related applications that run these cross-chain bridges. So they transport the DAI onto EOS, where they can do the transactions with high throughput transactions, small micropayments, and that kind of stuff. And then they can freely be transported back and forth. And a lot of other cross-chain bridges are coming as well. Some of them are kind of like similar, where it's like a single project that's running their own bridge for their own needs. And in other cases, there are these more decentralized solutions that bridges various blockchains, including projects like Keep. There's a project called Keep that does it, and there's actually a lot more. Like there's, I believe that we are tracking 7 different cross-chain protocols right now that we believe all of them are going to deliver very, very compelling solutions within next year. And in the long run, you could even see even more advanced solutions come that are based on something like Maker's governance system to create this like fully decentralized like spider web of cross-chain transactions that allows the Maker protocol to truly like transcend any single blockchain. But that still also means that when ETH 2.0 comes out, it's going to be just great, right? Because that just means that the Ethereum blockchain is going to get a lot of advantages. But I think what a lot of people don't realize is that the Ethereum, like the way that ETH 2.0 itself is structured, is kind of like being blockchain transcendent in the first place, in the sense that ETH 2.0 is about having a lot of, sharding means just running a bunch of blockchains at the same time. So you're already, like, if you want to be able to get the advantages of ETH 2.0, you have to start thinking today about how are you going to build your application so that it can exist across multiple blockchains. So because we've already done that, that also means we will immediately be able to get all the benefits of ETH 2.0 as soon as it launches.
Rune, thanks so much for coming on the show. Fascinating discussion. And as I mentioned several times, I'm super excited about what you guys are doing. So very much look forward to see what you ship next. Thanks so much for coming on the show and for sharing your insights.
Thanks so much for having me. It's great.
Thanks for listening. If you like this episode of the Blockchain VC and want to help us bring more awareness to the space, I'd really appreciate it if you can rate, review, and subscribe to our podcast. This only takes a few seconds and helps us get the word out.